today we're going to take a look at hedging a portfolio using CFDs. Now the beauty of this is there are a couple of ways to do that. We're going to go through the two major ones. One is hedging using an index and the other is hedging using the individual share CFDs. First things first, why would you want to hedge? Now, there are times when you might get a little bit nervous with the market hitting all-time record highs time and time again. So some people like to protect their portfolio, as in this example here. The move was so parabolic that it was inevitable that the market was going to, at some stage, give back those excellent gains. And it did pretty sharp and swiftly there. Now, it is very difficult to know when to do that. Hedging is what we would refer to as a little bit of a weak strategy because you're hedging your bets, so to speak, or you're hedging your investments in the knowledge that you don't know exactly what is going to happen, but at some stage you know that we're probably going to go into a downtrend or at least give back some of those profits. Now, as you can appreciate, a lot of investors, when they are sitting on profits, it is human nature that they want to lock those profits in, which means they need to close their existing positions. So as they start closing, it means they're selling, and as that starts to happen a little bit faster and harder and with more volume, the markets do pull back quite significantly. So hedging is just the ability to lock in some of the existing profits that you might have without physically selling the stocks that you might own. So we're looking at the S&P 500 index here, and it has hit successive highs. So some would argue that given the debt problems at the moment, the trade war issues that are going on in 2018, the China and US trade war, the Brexit issues that are going on, there is a lot of political and economic uncertainty around the world, especially with the emerging markets currencies crisis that we're seeing as well. So there's a lot at play, so a lot of people might be getting a little bit edgy in terms of where the market is going to go next. Where is the value coming from? Where are the value on the stocks that I can buy? Is there any more value out there? So now might be a good time to have a look at the potential to hedge a portfolio. Now the very first method is to hedge using an index. So for example, if you're trading the Aussie 200 stocks, then the benchmark that you would be trading, and you probably own a lot of blue chip stocks if that is the case, the benchmark that you want to look at is the SPY 200 or the Aussie 200 index. Now, it is pretty amazing how many people don't actually realize that you have the potential to hedge using an index CFDs. Now, when you talk to a lot of investors, the term hedging doesn't even come up all that often. So it is a bit of a foreign thing. However, hedge funds, obviously, as the name implies, they do use a lot of hedging strategies, not just this basic strategy I'm going to take you through today. However, a lot more advanced strategies, but suffice to say that it is good to have a bit of an idea of how you can hedge your existing portfolio. So if you have a blue chip portfolio and you do own a lot of the top 200 stocks, or at least a good portion of the top 50 blue chip stocks, then hedging using the Aussie 200 is a sensible way to go about it. What we'd be doing here is that we'd be taking a short position equivalent to our total holdings. If you had, say, $500,000 share portfolio in your self-managed super fund and you were looking to protect and hedge that, then you would try and look to hedge the equivalent of your total portfolio. If you had $500,000 in blue chip stocks, then you'd look to take the equivalent of $500,000 in index CFD contracts. So the quick way to calculate that, pretty straightforward. Bring the calculator over, type in 500,000 divided by the current price of the index, which is around 6,200, and that would indicate that we'd need to short sell around 80 contracts. So the number of contracts that you short sell is entirely up to you, but if you were to short sell 80 contracts, then every single tick would be worth $80 plus or minus. So as it's going against you, the theory would be your portfolio is going up at the equivalent of $80 a tick, and you are losing $80 per tick as the market rises in value. However, should the market plummet, then your portfolio should be going down at a reasonable rate of knots, but you've hedged, and so you'll be making $80 a tick as the market falls in value. So that's the first way to hedge. That's probably the most broad market way to do it. The other way you can do it is obviously using individual share CFDs. Now, if you're trading with a Forex broker on MT4, you cannot short sell share CFDs. So you'd need to have a CFD broker that enables that. Let's go and have a look at some of the stocks that you might be on right now if you own some blue chip stocks. BHP is a classic example of a stock that is in many portfolios. Heavy resource stock, obviously, one of the largest in the world. It's currently hitting a big ceiling. So some might think that this is a potential for a market to pull back, and certainly copper has been falling quite a bit of late. If we were to look at this particular one, we've also had lower lows coming down, and it's struggling at this level through here. Will it rise up through there? Could do. However, maybe you want to individually hedge that. If you owned $20,000 worth or $50,000 worth of BHP, then what you can do is go to the CFDs and hedge the exact amount that you own. So let's just say, for argument's sake, you had $34,000 worth and you had 1,000 BHP, then it's quite simple to short sell 1,000 share CFDs, and as the market fell $1, you would lose 1,000 on your portfolio and you'd make 1,000 on your short sold BHP share CFDs. So that's how you can do it on the individual share basis, and that's how you can do it on the index as a whole. So they're the two key methods that people use in order to hedge an existing portfolio, especially if you're running a self-managed super fund and you've got a couple of $100,000 or more of stocks and you don't want to physically sell them. They're two methods that you can do to lock in those particular prices right now. Hopefully you found this video helpful, and if you do, please give it a thumbs up, and of course subscribe to the channel for more videos like this. Thank you.